Hello and welcome to this leg of my tour of Canada's mortgage ecosystem. Last time I led off by saying that in general, in my opinion, there are three general species of mortgage lender in Canada, and that is traditional, alternative, and private. And today I'm going to talk about the easy one, the traditional mortgage lender. And there are three subspecies of traditional mortgage lenders: the banks, the monoline lenders, and the credit unions. And so these institutions have their ups and downs. First of all, obviously they offer the best rates in Canada, the rates that you see on TV and in billboards. They are nationwide. They offer no lending fees except in the case in which you are buying a property and putting less than 20% down, sometimes as little as 5%, which is a good thing actually for first-time home buyers, for instance. But in that case, you'll be paying a mortgage insurance premium to someone like CMHC. The downside to these lenders is that they are as tough as ever to qualify with for a mortgage. They're more rigorous than ever in terms of credit and credit worthiness. They're tough in terms of income, and in case you missed it, I wrote an article recently about how crucial income is now in qualifying for Canada's best mortgages in terms of the quality and reliability of that income and the verifiability of that income, not just the amount of money that you make. These institutions are also less sympathetic than ever in terms of the self-employed borrower, depending on your profile. So those are the ups and downs, but let's just get into each of the subspecies. First of all, let's talk about the banks. And you know these, the big six banks. In fact, there's 8 of them. We've got TD and Scotia. We've got BMO and RBC. We've got National Bank. We've got Canadian Western Bank. We've got Laurentian Bank, and I've missed one, I'm sure. But these are the big national brands that we all know that have physical branches throughout the country. So it's nice to have that bricks and mortar sort of a presence. They offer a wide array of financial products, not just mortgages, but auto loans and lines of credit. And of course, they take your deposits, which, by the way, is essentially the way in which these people access capital to in turn lend out to you in the form of a mortgage. There are then the monoline lenders. And these are Canada's national mortgage companies that only do mortgages, ergo the term monoline, mono. And there are names like MCAP and First National, Street Capital, RMG, CMLS, and a lot of people from previous generations are thinking, who the hell are these lenders? I mean, let's just stick with the banks, but the irony of the situation is that these companies are very large, they're nationwide, in many cases they're publicly traded. In fact, some have even applied and recently been awarded status as a second-tier chartered bank. And the upshot of it is this. Many of these monoline lenders, their largest investors or shareholders are the banks. Yes, the banks are some of the largest investors and shareholders in these products and brands with which mortgage brokers have made Canadian consumers so familiar. What makes them compelling is they offer very, very competitive rates and features as it relates to these banks as their competitors, but moreover, in many cases, when people are rate sensitive to fixed rate mortgages and they're worried about prepayment penalties and getting out of those mortgages, these monoline lenders offer very compelling and competitive penalties compared to their counterparts at the banks. So that's the monoline lender generally. Last of all, I will touch on the credit union, which I defined last time as more of an alternative lender, but it would be unfair of me not to say that by and large, credit unions offer traditional mortgage products. It's just the difference is that they are provincially regulated and they make local credit decisions. And for that reason, they're not subject to the federal regulations such as the new stress test. So just as sort of a basic example, pound for pound, a borrower may be able to qualify for more of a mortgage right now than they would at a bank because credit unions have a lower qualifying rate than the stress test that we're all familiar with. So these credit unions also offer an array of alternative lending products, which sort of blurs the line for them between traditional and alternative lenders. But I'll get into alternative mortgage lenders in my next chat with you when we continue our tour of Canada's mortgage ecosystem. For now, that's it. Thanks for watching. Have a good day, and we'll see you soon.